Welcome back to the deep dive. We are once again cutting through the noise, getting into the filings, the earnings calls, really trying to extract the key knowledge for you.
That's the goal.
Today we're diving deep into buy now, pay later, but maybe not the names that first jump to mind, like Affirm or Klarna.
No, we're looking at, I think, a really fascinating player that's kind of operating where the perceived risk is highest. We're talking Sezzle, ticker SEZL.
Sezzle. Okay. And they're targeting a specific niche, right?
Yeah, they've carved out this surprisingly profitable niche. They're going after the subprime and near-prime consumer, the demographic a lot of traditional lenders tend to shy away from.
Right. But the sources we looked at, the Q3 2025 10Q, the earnings call transcript, some investment analysis we synthesized, they all paint a picture of serious scale and, maybe more surprisingly, real profitability.
Exactly. That analysis even tagged them as a potential giraffe stock. Growth at a reasonable price. It's quite a claim given the market they're in.
So our mission today, really, is to figure out the mechanics here. How on earth did Sezzle pull off their first billion-dollar GMV quarter? That's gross merchandise volume.
Yeah, $1.047 billion to be exact.
While at the same time, they were doing this major strategic pivot, changing their product focus pretty significantly. How did they manage both?
Well, that's the core tension, isn't it? That's what we need to unpack for you.
Yeah.
Can a company growing this fast, focused on flexible short-term credit for, let's say, middle to lower income folks, can they really manage that credit risk effectively?
And deliver expanding margins while doing it.
Right. Does the execution actually justify the numbers and the, frankly, pretty aggressive outlook they put out there? We need to look closely at their tech, their underwriting, and these longer-term bets they're making.
Okay, let's do it. Let's unpack Sezzle. Tag IS Sezzle's unique identity in the BNPL landscape.
Right.
So let's start with who Sezzle is, their identity. You said they're not chasing the prime customer. That's a conscious choice.
Oh, completely conscious.
Yeah.
Their whole model is built around serving that segment that traditional finance often overlooks. We're talking subprime, near-prime users.
Primarily younger.
Yeah, mostly 18 to 45, generally speaking. Often people with thin credit files, maybe they don't have easy access to traditional credit cards, or maybe they've had bad experiences with revolving debt before.
Yep.
And Sezzle doesn't just want to be like a button at checkout. Their goal is much bigger. They want to be the user's main app for this stuff, a top-of-wallet app for shopping, for budgeting.
Top of wallet, okay. So if that's the user base, how are they structurally different from, say, an Affirm or even older Fintech models?
It's pretty different. Affirm, for instance, has moved more into longer-term loans, often interest-bearing. For bigger purchases, they partner heavily with big merchants.
Yeah.
Sezzle is still very much focused on that classic short-duration, interest-free installment plan, the pay-in-4 model. And crucially, their whole approach is way more app-centric, meaning their success really hinges on getting users engaged inside the Sezzle app, driving them to merchants who are integrated within their ecosystem, rather than just being a payment option someone clicks on a retailer site.
Oh, okay. So the app itself is key.
It's absolutely central.
Yeah.
And that app focus lets them gather much better behavioral data on their users, which, is critical if you're going to underwrite this particular demographic effectively.
That makes sense. Now, management talks a lot about this being a purpose-driven mission, about financial empowerment. How do they actually justify that, especially when dealing with potentially vulnerable consumers and comparing themselves to traditional credit?
Yeah, it's a line they walk carefully. They draw a really sharp distinction based on the structure of the debt itself.
Okay.
Their argument basically is that BNPL, their model, is fundamentally better, safer for the consumer than a typical revolving credit card.
How so?
Well, a credit card, it's kind of designed to encourage you to carry a balance, right? They make the most money when you revolve debt and pay that high compounding interest.
Right, the minimum payment trap.
Exactly. And that structure can easily lead to debt spirals and, unfortunately, sometimes even personal bankruptcy for the user.
Whereas Sezzle's product, it's more like a forced budgeting tool.
That's precisely how they frame it. The standard product is 4 payments over just 42 days. It's incredibly short term.
Very short.
So the consumer knows exactly what they owe and when, almost immediately. The loans are interest-free if you pay on time. And here's the key part for risk control. If you miss a payment, if you default, Sezzle's system kicks in right away. It limits or even cuts off your ability to spend more on the platform until you fix the situation.
Okay. So it forces accountability fast, like a speed bump, not an accelerator into more debt.
That's the idea. a financial speed bump.
Okay, that mechanism makes sense for controlling their own risk, but I want to push back a bit on the financial empowerment mission. What actual features do they have that support that identity? Is it just the pay in four model?
No, they've built out other things around it. Take Sezzle Up, for example.
Sezzle.
Yeah, it's a feature designed to help consumers who use the product responsibly actually build their credit history. It reports positive payment behavior to the credit bureaus. That directly addresses the pain point for those thin-file consumers.
Okay, that's interesting. What else?
They also have something called Money IQ. It's basically a suite of financial education tools right there in the app. Budgeting tips, articles, that sort of thing.
Right, and we saw they introduced pay in five plans too. Is that moving away from the core model?
Not really moving away, more like adding a bit of flexibility.
Right.
P&5 might offer a slightly longer term, maybe more spending power for some users, but it keeps that core principle. Very short duration, fixed, predictable payments.
Got it.
They're trying, or at least they say they're trying, to help users climb the financial ladder by demonstrating responsible credit use, rather than trapping them in that cycle of high-interest revolving debt. And they believe this whole ecosystem, the features, the education, the model builds loyalty, makes users stick around longer, and makes SEZL their preferred tool. Hashtag G3 2025 Financial Powerhouse Metrics.
Okay, so that focus on the app, on the engaged user, it definitely seems to have translated into some, frankly, eye-popping numbers in Q3 2025. This quarter felt like a real turning point.
It really did. A landmark quarter, no doubt. Let's start with the top-line growth, the scale.
Yeah, the GMV number.
Gross of merchandise volume, yeah. Climbed almost 59%, 58.7% year over year to hit $1.047 billion. That's the first time they've ever crossed the billion-dollar mark in a single quarter.
Wow, that's huge. Psychologically, operationally, that's a big threshold.
It really validates their ability to handle massive transaction flow. But, the monetization story might be even stronger.
Because revenue grew even faster than GMV.
Exactly. Total revenue was up 67.0% year over year, came in at $116.8 million.
So they're getting more revenue out of each dollar processed. The take rate is increasing.
Precisely. Their take rate, the percentage of that GMV they actually capture as revenue, it expanded to 11.2%.
Okay, 11.2%. How significant is that jump?
It was up 60 basis points, both sequentially from Q2 and year over year.
60 basis points? For people maybe not deep in finance, that's actually a pretty meaningful improvement.
Yeah, it's a very solid jump. It signals real efficiency gains in how they're monetizing.
So what's driving that? Are they just charging higher fees, or is it more about the mix of products?
It's a combination, but it seems primarily driven by that mix shift. It reflects this strategic push towards their higher margin products, the subscriptions we'll talk more about, combined with being able to standardize some consumer fees thanks to that bank partnership they have.
Okay.
Basically, they're getting better at optimizing who they lend to focusing on those stickier subscription customers and how they charge for the service. That 11.2% take rate, it's pretty high for the BNPL space. It says a lot about their confidence in customer loyalty and the value people see in those paid offerings.
And the really crucial part for investors, I guess, is that this massive growth isn't just, theoretical future profit. It's leading to actual bottom line results now.
Yeah, absolutely. That's the real story here, the profitability.
Yeah.
GAAP net income, that's the standard accounting profit. It jumped nearly 73%, 72.7% year over year, reached $26.7 million.
Wow.
Which gives them a GAAP net income margin of 22.8%.
23% margin, basically. For a company growing this fast, just crossing $1 billion in GMV, maintaining margins like that while still acquiring users is, it's pretty remarkable.
It really is. It lends a lot of credibility to that JAP thesis growth at a reasonable price. You're getting both.
Okay, so let's talk efficiency. Often when companies grow this quickly, they have to pour money into hiring, into systems. Costs can balloon out of control. How is SEZL managing that? Are they showing operational leverage?
This seems to be a real strength, and it ties into their tech focus. If you look at their non-transaction related operating expenses, think G&A, salaries, marketing, the more fixed costs.
Yeah.
They did increase up about 51%, 50.9% year over year to $31.6 million. Which sounds like a lot.
Okay, 51% increase in costs.
But remember, revenue grew 67%.
Okay. So costs grew slower than income. That's the key.
Exactly. That's operational leverage right there. As a percentage of total revenue, those operating expenses actually decreased by 2.9 percentage points.
Almost 3%. So for every new dollar of revenue, less of it is being eaten up by overhead.
Precisely. Think about it. They handled 67% more revenue, but only needed about 50% more spending on the fixed cost base to do it. It suggests their processes, that app-based model, and probably those AI investments we'll get to later, are really paying off. They can scale volume without needing a proportional increase in headcount.
And I assume that leverage flows through to adjusted EBITDA as well.
It does, clearly. Adjusted EBITDA grew even faster, 74.6% year over year, hitting $39.6 million. That resulted in a really strong margin of 33.9%.
34% margin on adjusted EBITDA, and that margin expanded.
Yep, expanded by 1.5 percentage points. So growing rapidly, expanding margins, in what most people see as a pretty challenging consumer environment. That's basically the definition of strong execution.
And finally, on the financials, they seemed pretty bullish about the future, raising their guidance.
Yeah, that was another clear signal of confidence. They bumped up their full year 2025 adjusted EBITDA guidance quite significantly, now expecting $175.0 million to $180.0 million. It's a pretty tight range, too.
Okay.
And maybe even more telling, especially if you're thinking longer term, they gave preliminary guidance for 2026, adjusted EPS earnings per share of $4.35.
And what kind of growth does that imply?
That implies about 29% growth over the 2025 estimate. So management is basically signaling they believe this current performance, this margin expansion, it's durable. It wasn't just a one-off good quarter.
Okay, you mentioned earlier that achieving this growth involved a pretty significant strategic pivot mid-quarter. Let's dive into that. First, can you lay out their main consumer products? How do they actually make money from users?
Right, so the consumer monetization ecosystem really revolves around, let's say, three main offerings currently.
Yeah.
Two are subscription-based. There's SEZL Premium. That lets users shop with Sezzle at certain premium retailers that aren't directly integrated into their standard network.
Got it. Pay a fee, get access to more stores.
Basically, yeah. And then there's Sezzle Anywhere. That one uses a virtual card, so you can use Sezzle's Pay in 4 pretty much anywhere that accepts Visa, even if the merchant isn't a Sezzle partner at all. Again, for a monthly fee.
Okay, so two subscription options. What was the third?
The third was the one they experimented with and then pulled back from, Sezzle On Demand.
On demand, that was newer, right? Introduced late 2024.
Yeah, Q4 2024.
How did that one work, and why did they seem to push it so hard initially?
So On Demand was different. It was designed as a one-time use virtual card. Instead of a monthly subscription fee, the user paid a finance charge that was added to their initial down payment.
Ah, okay. Pay per use, essentially.
Exactly. And the thinking behind it, the strategy, was that it would have lower friction for getting new users in the door.
Made sense. No upfront commitment, right? Just try it once.
Right. They hope to attract users who might be hesitant about signing up for a monthly subscription fee right away. Kind of broaden the top of the funnel.
Okay, so the goal was more users, more volume initially. And did they get that? I think their MODS metric, monthly on-demand users and subscribers, actually went up.
They absolutely got volume. The front-end engagement looked good. The MODS metric did rise. But the analysis pretty quickly showed that the economics of those users just weren't as good.
How so? What was wrong with the on-demand users?
Well, the customer behavior was fundamentally different. A lot of the on-demand users were basically one and done. They'd come in for a single purchase, pay that finance charge, and then they'd either churn, just leave the platform, or, crucially, they wouldn't convert over to one of the subscription products, which are much stickier and more valuable long-term.
So that's the core insight then. The lifetime value, the LTV of an on-demand user was just lower. It was actually hurting profitability.
That seems to be exactly it. It was kind of cannibalizing their core profit engine.
Why was the LTV lower? Was it higher fraud or just less repeat business?
It seems to have been both, to some extent. The subscription customers, first off, provide that reliable recurring revenue stream, but they also tend to exhibit better credit behavior, probably because they value the ongoing service more.
Okay.
The on-demand group, because it was easier to get into, likely attracted a slightly riskier initial cohort, leading to higher initial loss rates. But the bigger issue was purchase frequency. It was just way lower. Remember we said the subscription customers bounced back to using the service 6.5 times a quarter.
Yeah, that's high engagement.
Very high. The on-demand users just weren't generating anything close to that kind of repeat business. So the overall profit you could expect from an on-demand user over time was simply much lower than from a subscriber. Management even noted it was slightly cannibalizing the retention rates of their best customers, the subscribers.
Okay, so here's where you see if management is really data-driven or just chasing vanity metrics. They saw this data, and they reacted quickly. Mid-Q3.
Instantly. It was a very decisive reversal. They basically executed an immediate full pivot.
Pulled the plug on promoting on demand.
Pretty much.
Hmm.
They redirected nearly all their marketing spend away from on-demand and pumped it right back into acquiring SEZL Premium and SEZL Anywhere subscribers.
Right, back to the core.
The rationale was crystal clear. Prioritize lifetime value, LTV, over just maximizing the raw number of users coming through the door. The subscription customers, they realized, are the foundation of the whole durable, high-margin business model they're trying to build.
Because they stick around longer, buy more often.
Exactly. Better attention, higher purchase frequency, and better payment performance overall.
Yeah.
All of that supports that high take rate, over 11% that we talked about.
And did the numbers show this pivot worked quickly?
Seems like it did almost immediately. The subscriber count, which had apparently flattened out or maybe even dipped a bit during that on-demand push, rebounded strongly. Rose to 568,000 active subscribers by the end of Q3. So yeah, it looks like a textbook example of choosing quality of customer over just quantity transactions. And that focus on maximizing the LTV of the active users seems to be precisely why their margins are expanding even while you're growing the top line. Hashtag leisure, high V, credit risk, monetization, and macro environment.
All right, now we have to get into probably the most critical area for any lender in this space, especially subprime, credit risk, how they manage it, how it's performing.
Absolutely crucial.
Yeah.
Before we dive into the losses, maybe let's quickly touch on their revenue streams again, because that diversification is kind of linked to how they approach risk.
Okay, good point. Remind us of the mainstreams.
So revenue comes from four main buckets. First, merchant processing fees. That's the retailer pays Sezzle.
Your standard stuff.
Right. Second, subscription fees from those premium and anywhere products we just discussed. Third, interchange fees, which they get whenever someone uses one of their virtual cards, just like a credit card issuer would. And fourth, various consumer fees. This includes things like late payment fees, rescheduling fees, that sort of thing. And having these different streams means if, say, merchant fee revenue takes a hit, they have buffers elsewhere.
Okay, let's zero in on that last one, though. Consumer fees. Because the filing noted something pretty stark there. Income from consumer fees and late payments went up. Massively, like almost 300% year over year.
Yeah, it was a huge jump, up to $21 million in Q3 2025, compared to just $6.8 million in Q3 of 2024.
$21 million from consumer fees, mostly late fees. That seems, well, it seems to directly contradict that financial empowerment narrative we talked about earlier. How does management explain that kind of increase?
Yeah, that's absolutely the point of tension, isn't it? It's a tough one to reconcile. Management pointed to three main drivers.
Okay.
First, just the higher GMV. More transactions happening overall means, naturally, a higher absolute number of transactions are subject to fees. Makes sense.
Okay, scale effect. What else?
Second, they said a higher number of fees were actually assessed per transaction or per user cohort, perhaps. And third, and this was interesting, they cited the standardization of fees that came about because of their strategic partnership with the originating bank.
Standardization, meaning?
Meaning, the argument is, they're now applying consistent, predictable fee structures across a much larger, rapidly growing user base, rather than, say, opportunistically jacking up rates on consumers who are struggling. It's more about process and scale under the bank partnership rules.
Okay, I hear the technical justification, but still, tripling late fee income. Doesn't that inherently suggest a pretty heavy reliance on users who are, frankly, financially stressed and can't meet even that short 42-day repayment schedule? Is the company profiting significantly from people missing payments?
It absolutely raises that question, and it's something investors need to watch closely. The counter-argument management would likely make is that, look, by operating under this bank partnership model, they are bound by certain regulatory frameworks around how fees are assessed.
Right.
And these standardized fees, they'd argue, are still far less punitive than the compounding interest and multiple fees you'd rack up on a traditional credit card if you fell behind. Plus, as we mentioned, incurring a late fee is often tied to that immediate restriction on future spending.
Which, in a weird way, they argue is a form of empowerment because it stops the user from digging a deeper hole.
That's the argument. Whether you buy it's another question, but that's the framework they present. It prevents the debt spiral.
Okay. Let's pivot then to the core measure of credit health, the provision for credit losses, or PCL. What did that look like in Q3?
Right, the PCL. This is the amount they set aside anticipating future loan losses. In Q3, it was $32.1 million.
And how does that compare as a percentage of GMV?
It represented 3.1% of GMV. Now, that is up significantly from where it was last year. Last year, the comparison metric they used was as a percent of total revenue, and it was 2.2%. So 3.1% of GMV is definitely higher.
Okay, 3.1%. So losses are ticking up. Why did they accept that kind of jump? Is the portfolio deteriorating?
This is where that strategic choice comes back in. Management was very clear on the earnings call. They insisted this increase was not because the underlying credit quality of their existing established customers was getting worse.
So what was it then?
Instead, they said it was a calculated decision. They deliberately chose to loosen their underwriting criteria slightly and at the same time dramatically increase their marketing spend. Remember that jump from $2.7 million last year to $8.8 million in Q3.
Right, huge jump in marketing.
They did that specifically to acquire a large number of new users, particularly those high LTV subscription users we talked about.
Okay, so the theory is we'll intentionally accept higher initial losses on these brand new users.
Because their expected lifetime value, especially if they become loyal subscribers, far outweighs that upfront credit risk. It's an investment cost for acquiring potentially very profitable customers.
Got it. They're essentially pulling forward some expected losses into Q3 by accelerating that new user acquisition.
That's exactly the idea. New users, just by definition, always have the highest loss rates when they first join any platform. Their payment behavior isn't established yet. So, by bringing in a big wave of them in Q3, the overall loss rate for the quarter naturally ticked up. But they claim this is entirely planned and controlled.
And they believe their technology can handle this increased risk. Tell us more about that profit score underwriting model. What's special about it, and why should we trust it, especially in this subprime segment?
Right, the profit score. It's their proprietary machine learning model. It's kind of their secret sauce. Unlike traditional credit scores like FICO, which rely heavily on historical data that can sometimes be months or even years old.
Yeah, often backward-looking.
Exactly. The profit score is designed to be real-time. It pulls in not just traditional data, but also alternative data points and, crucially, real-time behavioral metrics from within the Sezzle app itself.
Like what kind of metrics?
Things like how often the user engages with the app, what categories they're shopping in, their transaction velocity, the repayment history on the Sezzle platform. It builds a much more dynamic picture of risk.
Okay. And that allows them to react faster if things change.
That's the key advantage they claim. It allows them to monitor risk pretty much in real time and, importantly, make very quick, very granular adjustments to individual users' spending limits or underwriting criteria if they detect increased risk signals.
So, if the macro environment suddenly gets worse, they can tighten the screws much faster than a traditional lender relying on older FICO scores.
That's the theory. That's the competitive edge they believe they have. And management was emphatic on the call. They said, look, despite all the widespread fears out there about consumer credit, health inflation, job worries, all that.
Yeah, lots of negativity.
They have not seen any unusual or unexpected deterioration in the underlying default rates on their platform, aside from the impact of deliberately bringing in those new, initially riskier users.
Okay. And the ultimate proof, then, that they believe this risk is contained is in their forward guidance on losses.
That really is the bottom line. That's the validation point. Despite intentionally acquiring riskier users in Q3, which pushed up the PCL for the quarter, management actually revised their full-year credit loss guidance lower.
Lower. Interesting.
Yeah, they tightened the expected range for the full year down to 2.5% to 2.75% of GMV.
So they're signaling that 3.1% we saw in Q3 was temporary, contained, and they expect the overall annual rate to be lower than they previously thought.
Exactly. It signals enormous confidence that the profit score model is working, that it's effectively filtering risk, and that they have a handle on the portfolio even in this macro environment.
But we have to adjust the market reaction because despite this confidence, the stock price has been incredibly volatile, right? Shot up after earnings, then crashed back down.
Oh, yeah. Dramatic swing.
Yeah.
Peaked around $82 after hours, then plunged back to the $58 level pretty quickly. Suggests a lot of fear out there.
What's driving that skepticism, do you think?
It's likely a combination of factors hitting it all at once. First, just general macro pessimism. Anything tied to the consumer, especially subprime, and especially higher growth, higher beta stocks, got hit hard in recent sell-offs.
Okay, sector rotation, macro fears.
Right. But then you add in the fact that SEZL has or had very high short interest. Reportedly, around 20.9% of the float was shorted.
Wow, that's high.
It is. And when a stock is that heavily shorted, any bit of bad news or even just general market fear can trigger rapid, almost mechanical selling as shorts cover or margin calls hit. it amplifies the downside moves.
So the analyst take, based on the synthesis, is that this volatility might be an overreaction?
That seems to be the consensus among the analysts covering it. They tend to view it as an overreaction to the market, punishing the stock for the general uncertainty around the consumer segment, rather than giving it credit for the demonstrated operational execution, the strong growth, and those expanding margins. #TAG-V, long-term strategy and corporate initiative.
Okay, so beyond just the quarterly numbers and the immediate risk management, Sezzle seems to be laying some important groundwork for the longer term. Structural advantages. Let's talk about their AI integration first. Is this real or just buzzwords?
It seems pretty focused on tangible efficiency gains, based on what they discussed. They've centralized their AI efforts under Killian Bracke, and the stated goal is explicit. Use AI to boost productivity and scale the infrastructure without needing to scale the fixed costs at the same rate. It's all about reinforcing that operational leverage we saw in the numbers.
Okay, can you give us some concrete examples? Where is AI actually making a difference right now?
They highlighted a couple of key areas. One is customer support.
The chatbot.
Exactly. Their AI-powered support chatbot is apparently handling a significant chunk of the routine customer inquiries now. That directly translates into needing fewer human support agents, lowering those associated costs.
Makes sense. What else?
The other big one is refining the underwriting model itself, the profit score. They're using AI not just to run the model, but to continuously learn and refine the parameters based on incoming data. This leads to better credit performance over time, hopefully, without needing a massive army of data scientists constantly tweaking things manually.
Got it. So the long-term play here is efficiency.
It's about creating a business that can handle, say, double or triple the transaction volume, but maybe only needs, 20–30% more support staff. That difference flows straight to the bottom line, maximizing gross margin.
Okay. Now let's look at some specific costs that signal these long-term ambitions. The filings mention $1.3 million in non-core expenses in Q3 related to corporate strategic projects. Not a huge number in itself, but what's behind it?
Yeah, small cost, but potentially huge strategic implications. It breaks down into three main initiatives they're pursuing.
Okay, let's take them one by one. First up, the antitrust lawsuit against Shopify. What's the story there?
Right, this is a potentially massive deal. They filed this lawsuit back in June 2025. Sezzle is basically alleging that Shopify, because it's such a dominant e-commerce platform,
Market share, yeah.
is engaging in monopolistic behavior. They claim Shopify unfairly restricts competition from buy now, pay later providers like Sezzle on its platform, allegedly prioritizing Shopify's own payment solutions or maybe giving preferential treatment to certain partners.
Okay, so if Sezzle wins, that could open up a lot of doors. A lot of merchants currently using Shopify.
Potentially millions of merchants, representing potentially billions in new GMV they could access if those alleged restrictions were lifted. It could dramatically expand their addressable market.
But what if they lose? Or what if Shopify gets the case dismissed? I think there's a hearing on that coming up.
Yeah, a motion to dismiss hearing is scheduled for December 2025. The stakes are definitely high. If they lose, it's not just the legal costs, but it could mean they remain somewhat boxed out, or at least face friction, competing within that critical Shopify ecosystem. It's a bold, aggressive move by management, shows they're willing to fight for market access. High risk, high reward.
Okay. Second strategic cost bucket.
Yeah.
Capital markets activity.
This is more about near-term planning, getting ready for the holiday season, which is always huge for retail and BNPL.
Right, Q4 prep.
They smartly executed what's called an accordion feature on their existing credit facility. Basically, they expanded their borrowing line.
How much?
Added $75 million to it. That increased their total borrowing capacity from $150 million up to $225 million.
So plenty of cash on hand to fund all those pay-in-4 plans during the holiday rush.
Exactly. Ensures they have ample liquidity, plenty of dry powder to handle the expected surge in transaction volume without running into any capital constraints. Smart financial housekeeping.
Okay. And the third, and maybe the most fundamentally game-changing strategic initiative, exploring a banking charter.
Yeah, this is the big one for the long term. They're actively exploring getting an industrial loan company charter, an ILC charter.
ILC. What exactly is that, and why is it such a potential game-changer for a fintech like Sezzle?
Okay, so right now, SEZL, like many fintechs, operates primarily through partnerships with existing licensed banks. Regulations in many places require a chartered bank to actually be the entity that originates the loan.
So Sezzle finds the customer, underwrites them, services the loan, but technically a partner bank originates it.
That's often how it works. By getting their own ILC charter, and they said they anticipate applying for one in the first half of 2026. Sezzle could essentially cut out that middleman. They could disintermediate the third-party partner banks.
Bring it all in-house. What's the financial impact of doing that?
Potentially immense, mostly through efficiency gains and margin expansion. If they originate the loans themselves, they capture the entire economic value of that loan.
Instead of paying fees or sharing revenue with the partner bank.
Exactly. They'd internalize that entire revenue stream, that whole economic spread. You would make each loan significantly more profitable, boosting their overall margins and making the business model much more accretive.
And why an ILC charter specifically, not a full bank charter?
An ILC offers many of the key advantages, like lending efficiencies, potentially a lower cost of funds, but typically comes with less stringent regulatory requirements than becoming a full bank holding company. It's seen as a more focused, capital-efficient way to gain banking capabilities without taking on the massive compliance burden of a traditional bank structure. It's a path other fintechs have explored or pursued.
Okay, so tying this all back together then, the overall valuation thesis, that sizzle over fizzle argument from the analysis, it really relies on both the strong current execution and this kind of long-term strategic foresight.
It absolutely does.
Yeah.
The bullish case, the reason someone might see this as a JARPOP opportunity,
Mm-hmm.
rests on viewing SEZL as a potentially powerful compounder, meaning it ticks a lot of boxes. High top-line growth, projecting strong EPS growth around 29%, already delivering impressive and expanding margins. That 22.8% net income margin is key.
Mm-hmm.
It's founder-led, high insider ownership, which aligns management with shareholders.
Right around 45% insider ownership, I think.
Yeah, very high. And they've shown remarkable discipline with issuing new shares.
Mhm.
Very low dilution, only about a 2.1% annual growth rate in shares outstanding, which is rare for a high-growth tech company.
Okay.
So you put all that together, the growth, the margins, the management, the low dilution, and then the investment analysis points out that based on standard valuation metrics like forward price to earnings or EV to EBITDA, SEZL appears to be trading at a significant discount compared to its peers, like Affirm or other growth fintechs.
So the argument is fundamentals are strong, strategy looks smart, valuation looks cheap relative to peers, creating an asymmetric risk-reward setup.
That's the essence of the bull thesis. An asymmetric setup for investors willing to look past the short-term volatility, provided, of course, that SEZL can maintain that high growth rate, keep those margins strong, and successfully navigate these strategic initiatives like the ILC charter. Hashtag tag outro.
Okay, so this deep dive into Sezzle really paints a picture of a pretty sophisticated operation. They're not just passively riding a BNPL wave.
Not at all. Seems very active, very data-driven.
They hit that major scale milestone, crossing the $1 billion GMV mark, and they did it while executing a really tough but apparently necessary strategic pivot, moving away from that high volume, low value on-demand product.
Back to the stickier, higher margin subscription model.
Yeah.
Which seems to be paying off in the financials.
And critically, on the risk front, they seem to have demonstrated, at least for now, that their profit score technology allows them to manage risk effectively, even allowing them to strategically increase risk through looser underwriting for new users, while simultaneously feeling confident enough to lower their overall credit loss guidance for the year.
Yeah, that lowering of guidance is a huge signal of confidence in their tech and their handle on the portfolio. They're also clearly executing on efficiency through AI and making these big long-term bets with the Shopify suit and especially that potential ILC charter.
Which could fundamentally change their profitability down the road by cutting out those partner bank costs.
Exactly. The challenge, though, the tension that remains, is definitely that perception of risk associated with the subprime segment they serve. And that's amplified, visually at least, by that huge jump in consumer fee and late fee income. It sits awkwardly next to the financial empowerment mission.
Right. So as we wrap up here, let's maybe circle back to that investment lesson the CEO apparently referenced, attributed to Warren Buffett.
Yeah, the quote about the stock market being a device.
A device for transferring money from the impatient to the patient.
Mm-hmm. And given the wild ride, Sezzle stock has been on recently, rocketing up to $82, then plunging back below $60, likely driven by short covering, followed by macro fears and maybe some short re-engagement. That quote feels incredibly relevant right now.
So for you, the listener, trying to make sense of this, the question really becomes, which side are you on?
Yeah, are the investors bailing out, now acting impatiently? Are they fleeing volatility that might be driven by technical factors like short interest unwinds or just broad market fear rather than a fundamental shift in Sezzle's story?
Or is the perceived risk actually justified? Is the market right to be nervous about the high PCL number, even if explained, the reliance on late fees, and the undeniable headwinds facing the subprime consumer in the current macro environment?
That's the decision you have to weigh. Do you believe in the potential for quiet compounding here, based on the execution and strategy management is laying out? Or do the immediate macro risks and market sentiment feel too daunting?
To help you track this going forward, we'd suggest keeping a really close eye on two immediate things.
Yeah. First, obviously, the actual credit metrics in Q4. What does that PCL percentage look like? Does it come back down as they suggested it would? That's critical validation.
And second,
The outcome of that Shopify antitrust suit hearing in December, a win, or even just surviving the motion to dismiss, could be a significant positive catalyst. A loss could reinforce market fears about their growth channels.
oh, lots to watch.
Definitely. Stay disciplined, stay analytical, and stay informed.
We'll catch you on the next deep dive.